morning, guys. It's Friday, March 14th, 5:28 a.m. Central Time. Grain markets are a little bit lower this morning. Brian Split is here. We were talking off camera. We hit 20,000 subscribers on YouTube, and I told Brian, I said that's very tiny for YouTube, and it is.
For us, it's fantastic.
We talk about corn prices every day, though. How many people are interested in the daily?
It's a very niche market.
Exactly.
I would agree. I think we're doing okay. All right, let's start off with export sales.
So U.S. wheat export sales were impressive last week, surpassing pre-report expectations. Net wheat sales were reported at 29 million bushels. The print was up noticeably from the previous week and up a whopping 83% from the prior 4-week average. Panama was the largest wheat buyer for the week. Net corn sales were reported at 38 million bushels. The print was up 6% compared to the previous week, but down 19% from the prior 4-week average. Mexico was the largest buyer for the week. Net soybean sales surpassed expectations at 28 million bushels. The print was up significantly from the previous week and from the prior 4-week average. China was the largest soybean buyer for the week.
What trade war, Brian? Look at these export sales.
It's a lot of bean sales. I mean, not only for we're in a trade war talk, but just this time of year, that's a pretty good soybean sale, considering this is typically when exports would drop off. Panama must need some wheat for their upcoming invasion when we get the American Canal, right?
Okay, so wheat sales were actually the star of the show, which is interesting considering that USDA reduced its projection for wheat exports just earlier this week. And if you continue at a pace like this, they may have to come back up. I know there's not a ton of time left in the marketing year, but you continue do another few weeks like that, they may have to come right back up. I threw a wheat chart in here since you're a chart guy. What do you make of this? So we had this big rally, and then we sold off, and we made fresh lows in this HRW contract on March 4th, and now we've tacked on 50 cents. It's odd. It's an odd pattern to me.
Yeah, I mean, the tough thing is you go all the way back to, let's say, like July, August, and this market's been in a big trading range. We're kind of like 550 to 650 is the overall range. And we've done that several times. So this last break was upper end of range to lower end of range rather quickly. You could see that we've kind of gotten back up to some resistance. So there was that high in about mid-January. We went right back up to that peak. So it's kind of mid-range here. If I don't have a position on, it's hard to establish a position right here in the middle of the range. But it seems to me like anytime you get wheat, and I'm kind of more focused on the new crop, the July contract, but anytime you get sub 580 into the 550, 560, 570, that looks like the low end of range. Look for exposure to the long side. And then when you get up to 6.25 to higher, up to 650, that seems to be the upper end of the trading range. But here we are smack dab in the middle, and we are visiting some resistance right now.
Corn export sales have been very good. We're the second or third best of the last 10 years, and we've been able to do it all without the help of China. I still think that any tangible evidence you could point to would say that USDA is understating exports, but we do have a trade war, and could there be cancellations? Could there be reduced purchases? I don't know. Brazil doesn't have much to offer right now, so I don't know. I'm going with the idea that USDA is too low.
Yeah, I think this has been more of a product of just timing and procedural, and we go back to the January report, big yield reduction, which then leads to large production reduction. And when there's a production reduction that large, they will typically reduce demand to help offset that production reduction, right or wrong. There wasn't any evidence in January like, oh, we're running behind pace, we need to reduce exports. It was more of a product of the reduction in the production side of things. So then you look back at the February WASDE, and a lot of the industry thought, well, they're going to raise exports right back up. But I think we both agreed they're not going to do that a month after they just lowered it. So then here we have the March WASDE report. I don't think they touch exports until we get through the quarterly stock report. That's going to be at the end of the month. And then maybe they'll look at the domestic side of the balance sheet again on the April WASDE. But at some point, they very well should raise corn for export based on the pace analysis that we're running right now. And I think when the funds got as long as they did in February, that underlying reason they bought so many contracts of corn is still there if we don't go into an all-out trade war and the exports crumble from here.
Here's a corn chart. So we had this trend line that comes off the August lows. It's pretty obvious we were able to hold that. Rallied up to 477 in the May futures, and now we've backed off, and we're kind of in the middle of what we've seen the last couple of weeks. What does this look like to you?
So it looks like we had a major break to the long-term uptrend. We recovered about half of that break in a pretty short order. And I think, to me, we probably, over the next couple of weeks have some things that might push the market back down to the low end of that range. I think that low that we made last week should be a good, strong weekly low. If you look at it on a weekly basis, we opened and closed at about the same price. It was at the upper end of the weekly range, and there's a large tail below the market. So they call those dragonfly dojis. I don't make these names up, but that's what they're called, and that should be the end of a bear trend, is what that weekly bar is supposed to be. But I don't think that means we need to go up immediately and go right back up to the highs. I think that just means last week's low is a strong low, and we're probably going to chop around and consolidate, and maybe 440 to 480 is a good trading range for the time being.
Here's soybeans. China was the biggest buyer of U.S. soybeans last week, but the tariffs went into effect. Chinese tariffs on beans went into effect on Monday. And I can't help but wonder how that might impact sales or lack thereof, or cancellations perhaps in the near future. The bean market's been trending lower since early February, basically.
Yeah, essentially, and late January even. Beans went right back down to what should be some very good support. That general just below $10 area held pretty religiously, with the exception of that break in mid-December, and that was 2 days down and then a couple days back up, and then we've held it ever since then. So we really don't want to see May beans below 990. But I think there's some chatter, like, could they cancel some soybeans? Yes, they possibly could. They've also been selling beans out of state reserves, and they did that with corn several years ago, and then they started to turn over their corn supply, and they needed fresh corn to refill their reserves. So that's going to be something we should watch, is the state auctions in China. And I also think that as they procure more South American soybeans, those don't store very well, so they're going to need U.S. soybeans, high quality beans, to blend those off. So I still think there's going to be a demand for U.S. soybeans regardless of trade policy here.
All right. Speaking of trade policy, let's go to the latest tariff update.
On Thursday, President Trump threatened to impose a 200% tariff on European wine, champagne, and spirits. The tariff is a response to the EU's proposed 50% levy on American whiskey, which was triggered by Trump's decision to impose a 25% tariff on steel and aluminum imports. Earlier this week, the EU said it would also slap tariffs on various U.S. agricultural products and other goods in response to the steel and aluminum tariffs. The European Commission president emphasized that while the EU is open to negotiations, it will defend its interests. Trump is expected to discuss the escalating trade tensions with the EU official in a phone call today.
Over the top with 200%, huh? Not messing around.
No, turn it up. Turn this baby up to 11.
I wanted to talk about this as it relates to ethanol, because both the European Union and also Canada are big importers of U.S. ethanol. Canada accounted for 35% of all U.S. ethanol exports last year. The European Union was 13%. So Canada and the EU combined are almost half of all U.S. ethanol exports, and ethanol exports make up we export 12% of what we produce with ethanol. So it's a big deal. I have been told, however, that they've got more strict climate policies in Canada and also in the EU, and that essentially they can't afford to go without ethanol from the United States. So maybe that's why they haven't mentioned U.S. ethanol with regard to tariff retaliation. Does that make sense?
It does, yeah. I mean, if you think about a lot of the green initiatives around the globe, a lot of that stuff is led by the EU. It's the reason that some German manufacturers are peeling back from making V8s and stuffing batteries in cars. It's all because of the EU. So yeah, I mean they have much tougher regulations over there. They need the ethanol, but still, it's a scary prospect when you think about potential of trade war and where it could go, and with Canada and the EU taking as much ethanol as they do. And we talked about that weeks ago when everything kind of flared up with Canada, just how much ethanol that they do take from us. So no one wants to see a potential demand base walk away from the table. But thus far, I think the trade war is not really ramped up too aggressively. Hopefully, I don't know how this thing evolves in the next couple of months, but hopefully we add tariffs and then take them back off pretty quickly. I don't want to see them keep adding and adding and adding, because if you think about, what was it, 2018, it was like every 3 to 4 months we were slapping new tariffs on China.
Yeah. Ethanol stocks are super high, And that's why this is of particular concern right now. Seasonally, will trend lower as people start driving more. We hope that's the case this time around. And ethanol, of course, is a big deal because that's 36% of all demand for corn grown in the United States. So it is something to pay attention to.
CONAB raised its outlook for Brazil's total soybean production on Thursday. The Brazilian crop agency pegged the crop at 167.4 million metric tons, up about 1% from its February forecast and well above the all-time high record of 155.7. The increase comes despite hot and dry weather in the southern portion of the country. Chinese demand for Brazilian exports is anticipated to rise due to the U.S.-China trade war that has emerged here in recent weeks. The agency also slightly increased its forecast for total corn production to 122.8 million metric tons. That's up 6.1% from last season. Earlier this week, the Rosario Grains Exchange revised its forecast for Argentina's soybean crop downward by 2.1% to 46.5 million metric tons.
Again, we've got these USDA versus CONAB, Brazil, Argentina disparities. USDA is a little bit higher with the production estimates. Still, when I look at like the ending stocks forecast, I just don't know, based on what we know about the crops, I don't know that they're that far off.
No, and USDA's started at 169 for Brazil's soybean crop. They're still at 169. We've had a lot of the private, industry in December walk that estimate up into the mid to upper 170s, then it kind of came back down. So USDA, might have been pretty on point from the beginning. We'll see, where things shuffle up here as the crop finishes. But I would also mention, we talked about some discrepancies between CONAB and the USDA, and we think back to last year's crop. I just think it was pretty interesting that the USDA in this March WASDE report decided to lower the previous crop of corn out of South America. They lowered Brazil by 3 million tons and then raised Argentina 1. We talk about these discrepancies between USDA and CONAB, and here we are, March of the following year, where they're finally revising lower some of Brazil's production, which was argued about for months, and then we kind of just like, all right, well, they're never going to come together. But here we are, months and months later, where they're making those revisions.
No, they don't have to come together. Just add the two estimates together, divide by 2, and just use that as your number. Brazil's going to be the biggest soybean exporter this year by a country mile. 58% of all soybean exports projected, and that percentage, that 58%, is probably a number that continues to work higher over the next, call it 5 to 10 years.
Yeah, and this is not a new trend. I mean, you might have said, oh, well, the trade war really took away our market share. The Brazilians have been taking soybean market share since the early to mid 2000s. China really started to invest a lot of money in Brazil, improving their infrastructure. So the Chinese really helped stimulate the growth of the Brazilian soybean crop. And then that has then started to take over market share over that last 20-ish years. So this is not something that is a new development.
And it wasn't that long ago that we were talking about the idea that, hey, we're going to crush so many soybeans in the United States that we're not going to need the export demand. And we're still going to crush a record amount of beans this year and probably next year. But the biofuel policy that was greatly needed is very much missing still.
Treasury Secretary Scott Bessent stressed the administration's long-term economic focus yesterday. According to Bessent, the Trump administration is not concerned with short-term market volatility. Instead, the administration is focusing on policies designed to promote long-term growth and stability in the markets and economy. Bessent stated that the real economy and markets would eventually prosper. His remarks come as the stock market entered correction territory yesterday, driven by ongoing trade concerns. Bessent emphasized that well-implemented policies would foster economic growth, job creation, and continued asset appreciation.
Bessent is a sharp dude, and I find it interesting that the messaging out of the White House has been pretty uniform, really. Bessent, also Howard Lutnick, who's the Commerce Secretary, and Trump have all kind of gone with this idea and have stated this idea that like things may be tough now, but they'll be better later. Trump was on Fox Business, I believe, earlier this week with Maria Bartiromo, and she asked him about recession possibilities. He said, I hate to predict things like that. There is a period of transition because what we're doing is very big. And I think when he says transition, he means like, yeah, maybe it'll be tough for a little bit, He stopped short of saying, "Hey, we're going to be in a recession," but I think that the messaging has actually been. I'm not going to say it's positive, but it's good that they're on the same page.
Yeah, I mean, there seems to be a goal that they're trying to achieve right now, and I think that the U.S. has an awful lot of debt that needs to be refinanced, and I think what their goal is some short-term pain, dealing with some of the volatility in the stock market, dealing with now, we've seen over a 10% correction in the stock market, so it's getting the talking heads very active. But, is this needed so that all of this debt can be refinanced at a lower interest rate? I think that's what they're trying to do. Whether it works out that way, I don't know. But I think they're going to have to. They're trying to create the conditions where interest rates can come down, and then we can refinance all of this U.S. fiscal debt at a much lower interest rate, saving us gobs and gobs of money in the long run.
I've heard that theory. I've also heard something called the hard reset theory. And the hard reset theory is the idea that Trump believes, right or wrong, that the Biden economy was all smoke and mirrors and that it was propped up by stimulus checks and the Inflation Reduction Act and government spending and government hiring, and that Trump wants to
and
undo
fake
that.
data too, right? Fake data out of jobs numbers and all of that. That's
Yeah,
ill
and that
advised.
so Trump wants to undo the Biden fake economy. That's I think the way that he would. That's not me saying that. That's I think what he's thinking to some respect. That's the theory that I've heard elsewhere, is that he thinks the Biden economy was this fake thing propped up, and he's gonna break it down and build it up. Does that make sense?
Mm-hmm.
I think that's maybe that's part of it. I don't know. You ask, when they ask Trump, why are we doing tariffs? There's a different answer almost every time. It's because it's fentanyl. It's because it's immigration. It's because of trade imbalances. I mean,
It's so, we don't have to pay income tax, right? There's multiple
I'm all
different
for it.
angles, right? Yeah, that was something that they were talking about yesterday was, $150,000 of income or less. We don't want you to have to pay income tax. That'd be an
Let's go.
interesting objective to meet.
So, USDA released weekly drought monitor data yesterday. Rainfall was scattered across the Corn Belt last week, and as a result, drought conditions improved in northwestern Indiana, central and northern Illinois, central and southern Iowa, and much of Missouri. A lack of precipitation caused conditions to deteriorate in western Illinois and western Minnesota. The High Plains also experienced scattered rainfall. Drought conditions improved in north central Nebraska and across parts of Kansas. However, a lack of rainfall led to worsening conditions in southern Kansas and northern Oklahoma. When we look at the percentage of U.S. areas experiencing drought, corn country 55%, soybeans 46%, winter wheat 27%, spring wheat 39%, and cattle country 38%.
There wasn't a ton of rain over the last week, but I'll tell you what, the next 7 days, and then you go out through the next 2 weeks, this looks like a potential Western Corn Belt drought buster to me. I don't know how accurate this is. These forecasts, of course, beyond 7 or 8 days are notoriously unreliable, but that's a whole bunch of rain in the forecast for Iowa, for Minnesota, slightly less for South Dakota and Nebraska. North Dakota kind of left dry. I don't know if this is accurate or not, but this would be a big deal potentially.
So when I see this map, one of the things that the weather guy that we talked to quite a bit, Eric Snodgrass, he said pretty consistently that if we're going to see a lot of rain, it's going to be in the eastern Corn Belt as we get into the growing season. Something that I think if I just look at this map, my brain says, okay, sell corn and then buy hard red wheat. That's what my brain says. Because you look at how we're going to continue to see that dry conditions persist in the HRW regions overall. I mean, we'll see, how this precipitation drops or if it evolves and goes into some of our HRW regions. But I think that's been what's supporting the wheat market recently, is a lot of that dry concern in HRW growing regions. And this would be a major change to the drought monitor for a lot of the corn and soybean production regions. So we'll see, like you said, how accurate is the map and what actually falls. But that's what my brain's thinking at this moment.
And out of the 3 classes of the wheat traded on the exchange, HRW acted the best yesterday. It had the best looking close. It's the best looking chart, I think, just over the very near term. And maybe the weather is part of the reason for that. You've got rain coming for SRW country, but not so much for HRW country. What did cattle do yesterday?
Cattle futures were mixed. Live cattle were 12 cents lower to 65 cents higher. Feeder saw losses ranging from 2 cents down to 75 cents. Box beef was lower. Choice was down 141 at 319.69, and select was down a mere 6 cents at 307.47.
It's still a pretty bullish looking chart. That trend, that regression channel that I've got on here, Brian, is only half of a standard deviation, which is it's a very tight uniform uptrend that's been in place for 4 years.
Yeah, it's a very strong uptrend, and when I think about where April live cattle made some lows here recently, right against the 200-day moving average, we had a big reversal off the 200-day, and this market has been behaving pretty well inside of this upward trending channel. So when I think about some of the deferred contracts, you've got December, for example. Had a really tough time around that 197 area. We've kind of broken through that, made some new contract highs there. So deferreds are starting to work their way up to 200. It'll be interesting to see if we can get October, December type contracts above 200. But, in going back to, what is maybe the biggest risk for live cattle, and it seems to always be the big picture macro economy, because the fundamentals of what's going on in the cattle market itself continue to be friendly. But what happens if it is one of those things where we do need to bring equities down, consumer confidence takes a hit in order for the big picture debt to be refinanced at lower interest rates? That would be something I think would likely be negative to the cattle market if that was the long-term outcome that they're shooting for.
Outside markets on Friday morning, U.S. dollars off a little bit. Stocks attempting a recovery. The S&P's up 44 points. The Dow's up 220. Bonds are about flat. Crude oil's up 60 cents, and the April WTI at 67.15. Have a great weekend, guys. Brian, thanks for joining us. We'll be back on Monday.